Can inflation persistence really determine US Treasury yields? Today, we're discussing a highly debated topic in the market. Is inflation persistence truly a decisive factor behind long-term US Treasury yields? Or is it a macro narrative that appears internally consistent, yet may not withstand empirical scrutiny? The so-called sticky price consumer price index is widely regarded as an important indicator of inflation persistence. It is constructed by isolating components within the CPI basket, whose prices adjust relatively infrequently. Because these prices change more slowly, markets generally view them as better reflecting expectations about future inflation trends than items with more frequent price fluctuations. The key question, however, is whether it has a decisive influence on long-term US Treasury yields. From a historical perspective, the sticky price consumer price index peaked in December 2022, whereas the yield on the 10-year US Treasury did not reach its peak until October 2023. Moreover, during the period from February 2023 to October 2023, the sticky price consumer price index continued to decline, while the yield on the 10-year US Treasury higher instead. This divergence in trends is not an isolated case. The yield on the 20-year US Treasury exhibits a similar pattern. This raises a direct question: if inflation persistence is indeed the determining factor for long-term interest rates, why did long-term yields rise while the indicator of inflation persistence continued to decline? Let us return to the pricing logic of US Treasuries. US Treasuries are essentially fixed cash flow securities, and their prices equal the discounted value of future cash flows. Yields on short-term Treasuries are tightly anchored to the policy rate, while yields on long-term Treasuries depend more heavily on expectations about the future. In today's financial markets, there are several mainstream approaches to estimating future average inflation. The first is the TIPS break-even inflation rate. Treasury inflation-protected securities are bonds indexed to inflation, and the break-even inflation rate derived from them reflects market expectations for a future inflation. By comparing the yield difference between TIPS and nominal Treasuries, one can infer the market-implied inflation expectation. In addition, survey-based measures, such as those conducted by the University of Michigan, the Philadelphia Fed Survey of Professional Forecasters, and Blue Chip also serve as important reference points. These surveys typically collect forecasts and opinions on future inflation from professional economists, market analysts, and business professionals. The University of Michigan's Consumer Survey reflects consumers' expectations and confidence regarding inflation, whereas the SPF and the Blue Chip surveys focus more on the perspectives of professional institutions and experts. In addition, models from authoritative institutions, such as the Federal Reserve and the IMF, also play an important role in measuring inflation. These organizations use complex economic models that take into account a wide range of macroeconomic factors to forecast future inflation. For the assessment of term risk premiums, specific models are typically relied upon. The Kim-Wright model is a classic term structure of interest rates model that evaluates term risk premiums by analyzing the yields of bonds with different maturities. The ACM model is another commonly used approach. In addition to the term structure of interest rates, it also takes into account the impact of macroeconomic factors on term risk premiums. In addition, major Wall Street institutions also develop their own internal models based on their research and experience to assess term risk premiums. These internal models often incorporate each institution's particular strengths and characteristics. However, different models and different parameter choices can lead to significant differences in results. This is because every model has its own assumptions and limitations, and varying parameter settings can have a substantial impact on the model's outputs. All three components of long-term interest rates originate from the expectations of market participants. This in itself clearly shows that the pricing of long-term rates is an extremely complex, multi-factor game. In this process, numerous elements interact and influence one another, including the macroeconomic environment, monetary policy, market sentiment, and investor preferences. How could any single factor possibly be decisive? From July 2022 to August 2024, the yield curve between the 10-year and 2-year US Treasury bonds remained inverted for an extended period. According to the logic of government bond pricing, an inversion typically implies that the sum of expected future short-term nominal interest rates, expected future average inflation, and the term risk premium over the corresponding maturity is expected to decline. However, in reality, the policy rate was not cut until September 2024, when it was lowered from 5.5% to 5%. By that time, the prolonged 2-year inversion had already ended. Didn't the rate cut come rather late? In addition, although the sticky price consumer price index did decline during this period, long-term Treasury yields, after peaking in October 2023, moved into a range-bound pattern rather than a sustained downward trend. This suggests that the sum of expected future average inflation and the term risk premium for the corresponding maturity did not decline in tandem. This brings the question back once again. If indicators that are meant to represent inflation stickiness are declining, yet long-term Treasury yields are not falling accordingly, doesn't this further weaken the claim that inflation stickiness determines long-term interest rates? Are we facing higher inflation expectations or longer-lasting inflation expectations? Higher inflation expectations means the market believes the future level of inflation will shift up to a higher range, for example, rising from 3% to 4%. Investors would then think the purchasing power of the interest I receive in the future will be lower, so I need a higher yield. Under such circumstances, the sticky price CPI and long-term US Treasury yields should exhibit a stronger positive correlation. However, this does not align with what we actually observe in the data. What about longer-lasting inflation expectations? Longer-lasting inflation does not necessarily mean inflation is higher in level. Rather, it means inflation proves persistent, fluctuates, and is difficult to bring down, while the effectiveness of policy becomes uncertain. In this situation, investors worrying that central banks may be losing control, that fiscal dominance over monetary policy could emerge, with a tendency toward debt monetization, and that geopolitical and policy uncertainty may intensify. The risk, therefore, is no longer simply the level of inflation, but uncertainty surrounding institutions, policy credibility, and the broader macro framework. In such an environment, what investors demand is not just inflation compensation, but a higher risk premium overall. During the Trump administration, a series of policies had far-reaching impacts on the economic and political order of both the United States and the global system. In the economic sphere, the administration took a forceful approach toward the independence of the Federal Reserve as the core decision-making body for U.S. monetary policy. The Fed has long emphasized its independence in order to ensure the professionalism and stability of monetary policy. However, driven by short-term political considerations, the Trump administration frequently sought to influence the Fed's monetary policy decisions, attempting to pressure it to adjust interest rates in line with its preferences. Such actions disrupted the long-standing tradition of independent central bank operations and planted potential risks for the long-term health of the U.S. economy. At the same time, the Trump administration significantly expanded direct investment in certain industries and companies. On the surface, these actions were framed as efforts to promote industrial development and create jobs, but in practice they carried the risk of favoritism and political allocation of resources. Such non-market-based direct investment can undermine fair competition and lead to distortions in resource allocation. In the area of international trade, the Trump administration launched a tariff war that had global repercussions. High tariffs were imposed on goods from multiple countries, including long-standing U.S. allies and major trading partners. This form of trade protectionism significantly disrupted the global free trade system and triggered retaliatory measures from other countries, leading to escalating tensions in global trade. The tariff conflict severely affected global industrial and supply chains, sharply increased production costs for businesses, and left consumers facing higher prices. As a result, it introduced substantial uncertainty and downward pressure on global economic growth. On the international political stage, the Trump administration took on an overtly bullying posture. It implemented a series of economic sanctions and political pressures against countries such as Venezuela, Cuba, and Iran. Even NATO ally Denmark was not spared, as the administration openly expressed interest in purchasing Greenland. Such actions, which disregarded the sovereignty of other nations and international norms, fully exposed the administration's hegemonic tendencies and seriously undermined international order and regional stability. Taken together, doesn't this suggest that longer-lasting inflation expectations better explain the current relationship between the sticky price CPI and long-term U.S. Treasury yields? From the observations above, we can see that there is no stable, trend-following relationship between the sticky price CPI and long-term Treasury yields. Long-term interest rates primarily reflect the combined outcome of multiple expectations and risk premiums. Models built on estimates and forecasts are not decisive. They can serve only as a reference. Therefore, a more cautious conclusion can be drawn. The claim that inflation stickiness determines long-term U.S. Treasury yields is less a rigorous pricing logic and more akin to a macro narrative that is explanatory but not a sufficient condition. At present, greater attention should be paid to risk events and their impact on long-term U.S. Treasury yields.